Hi everyone, welcome to another presentation in the Option School series. Today I'm going to be discussing basics of covered call writing. First of all, let me explain to you what the call options are. Then I'm going to be talking about what is call writing. I'll illustrate the concept on a few examples, and then I'll go over the risks and rewards, give you a few real-world examples, my actual trades, and then I'll finish with the guidelines for covered call writing. Okay, so what are call options? So a call option gives the buyer the right, but not the obligation to buy an underlying asset at a predetermined price within a specified time period. So you can see it's usually time limited. There is always a predetermined price, and it's the right, but not the obligation to buy the underlying asset. For us, the underlying asset will be stocks or ETFs. And so when an investor buys a call option, they're essentially paying a premium to acquire the right to purchase the underlying stock or ETF at the strike price. And this can be very advantageous if the investor expects the price of the underlying asset to rise. And if the price increases above the strike price, then the investor can exercise the option, buy the asset at the strike price, and potentially sell it for a higher price on the open market and generate profit. Okay, so this was, mouthful. So let's look at a few examples. So assume we have a XYZ stock trading at 49 on the 5th of May. And so we can buy one XYZ call, say at the strike price of 50, expiring 2 weeks later. And the premium we have to pay is $2. So the total invested is just we pay $2. Each call represents 100 shares. So 100 times 2 is $200. So we spend $200. And if the XYZ stock is trading at 55 2 weeks later on the expiration date, and then since the price of the underlying is bigger than the strike price, the buyer, that means us, will exercise the call option and buy the 100 shares of XYZ at $50 a share, and then the buyer can sell it back on the open market at 55 and generate the proceed of over about $500, right? And so we spent $200 initially, and we received 500 when closing the trade. The total profit is $300, which is about 150%. So you can see why people like options, because from very small investment, you can generate nice profits. But the tricky part is the stock has to move in your direction, and it has to move in your direction quickly to generate the profits. One thing I wanted to add here, uh, usually the buyers, the individual investors, they don't exercise the options. They typically would go on the open market and just buy the option for $2 and then later sell it back for about $5, before the option expires. And it would generate about the same profit of $300. So, but this presentation is about call writing or call selling. So let's look at what that means. So selling covered calls or writing covered calls is a strategy that involves selling call options on shares of the underlying stock or ETF that an investor already owns. So the investor collects a premium for selling the option, and they can keep the premium if the option is not exercised by the buyer. In fact, they can keep the premium even if the option is exercised by the buyer, but they just have to sell the stock to the buyer at the strike price. So let's look at an example. So again, we have our XYZ stock trading at 49 on the 5th of May. So I can go on the open market, buy 100 shares of XYZ at 49, and then I can sell one covered call at 50, expiring 2 weeks later, and receive a premium of about $2. right? So total invested, so I spent $49 per share on the stock, and I got $2 back for each option, for each share of the option. So that would be total investment would be about $4,700, right? So if the XYZ stock is trading at 51 2 weeks later, well, 51 is more than the strike price. So the option gets exercised and the shares are called away. That's why why the option is called a call, right? So the shares are called away. And so I'm obligated to sell my 100 shares of XYZ at $50 a share. That's part of the contract when you buy and sell the option. So the total proceeds for me would be $5,000 from selling the shares. And since my initial investment was $4,700, the profit is $300, which is about 6%. Now, if I didn't sell the call option and just bought XYZ stock on the open market for 49 and later sell it for 51, right? My profit would be about $200, which is roughly 4%. So in this case, selling covered calls actually gave us a little more profit. Now, a different example, assume that 2 weeks later, the stock is trading at 49. Well, that means that the call option buyer would not exercise the stock, right? There's no point, trying to buy the stock at 50 when he can buy it on the open market at 49. And so the option would expire worthless. So we can sell now the stock at 49 on the open market, and which would give total proceeds of 4,900. And since our initial investment was 4,700, our profit would be about $200, which is roughly 4% of the initial investment. Without selling the call option, right, we would just buy the stock at 49, sell it back at 49. So our profit would be exactly zero. So we would just break even. So again, in this case, selling covered call gave us extra profit. Now, another example, okay, so here the stock kind of didn't move, right? It was 49 at the beginning of the trade and 49 at the end. Now, assume that the stock actually goes down. So it's trading, say, at 47 2 weeks later, right? So again, the option would expire worthless, and we can sell the stock at 47, and total proceeds from selling the stock would be 4,700, and the profit for us would be exactly $0. So it's a break-even trade. However, if we didn't sell the covered call, we would buy the shares at 49, sell them at 47, which would be about $200 loss, right? So again, selling covered call in this case helped actually, instead of losing trade, we ended up with a break-even trade. Now, finally, the last example. So assume that the stock is trading at 55 on the 19th, right? So that's a pretty decent move. So in 2 weeks, the stock moved about 10, actually a little more, let's say 12%. So the stock moved 12% in 2 weeks, which is very unusual, right? But anyway, so at the end of the trade, the price of the underlying is $55. So the buyer of the call option would, of course, exercise the option. So we would be obligated to sell to him our shares at $50 a share. So the proceeds for us would be $5,000. So the total profit would be about 300, right? We spent 4,700 at the beginning and ended up with 5,000 at the end. So that's pretty good. We're still making $300, which is about 6% in 2 weeks. Not bad. But if we didn't sell the covered call, our profit would be, much bigger, right? Twice as big, in fact. So instead of $300, we would have made 600. But you can see, so in this case, of course, it would be better not to sell the covered call. But the difference between the profit from with or without the covered call is actually not too bad. Well, it's twice as much, but the likelihood of getting here is quite small. So that brings me to the risks of selling covered calls. So first risk, of course, as with buying any investment, since we buy the underlying, right, we actually risking the entire investment. If there is a bankruptcy or something bad happens, you know, and XYZ stock trades all the way to zero 2 weeks later, then we lost the entire investment, meaning $4,700. Uh, Notice that without selling the covered calls, we would lose the entire investment also, but it would be $4,900. Right? So the other more real and more common risk is the limited profit potential. So this is the case when the stock goes up very quickly and quite a bit, right? And the selling the covered calls essentially puts a limit on how much profit we can make. So the investor's profit is limited by the strike price of the option plus the premium received, right? So this is a crazy example. So if the XYZ stock trades at 100 on 2 weeks later, that means a gain of more than 100%, right? So our profit would again be $300, which is 6% of the underlying uh, of the initial investment. However, the profit without writing the covered call would be, $5,100, which is more than 100%. So this is the risk. This is the risk of selling covered calls. That's the real risk when uh, you sell the covered calls and your profit is limited. But many investors are actually okay with it. It's not bad if in 2 weeks you can make 6% on your investment. That's actually pretty nice. And if you can do it over and over and over, that's a very solid return. So, what are the rewards? So, of course, anytime we sell the covered call, we get some premium and we can immediately use it. We can withdraw it from the account or we can use it to buy other investments. You can also look at selling covered calls as kind of increasing the yield on the stock or underlying ETF. If you have 100 shares of SPY, you would get about 1.2% of dividend over the whole year. So every 3 months, you would get some cash into your account. Uh, so you can kind of use covered calls and sell them, say, every 3 months or every month or every couple of weeks and get some cash into your account. So you can view uh, the covered calls essentially as additional yield on the underlying. Right? Another good benefit of selling covered calls is that profitable trades are more likely. So even if, say, the XYZ stock trades at 48, which means it went a little bit down in the 2 weeks, we can still generate profit of about $100. On the other hand, without the call, it would be a losing trade, right? So profitable trades are more likely. And similarly, losing trades are losing little less, right? So if the stock goes down quite a bit, we can reduce the loss by the $200 that we got when we initially sold the covered call. So let's look at a few examples. Here are the examples of my own trades. So in my IRA account, I had 500 shares of AMD, and on the 9th of May, I decided to sell 5 covered calls against those shares. So AMD was trading at around 95.40. So I sold 5 covered calls for 80 cents each. So the total income I got was close to $400. And 3 days later, AMD at the close was trading just at about the same price. So way below the strike price of 98. And so the option expired worthless and I got to keep the shares at the same time. So my total income was close to 400. about 0.83%, and the total profit, well, the stock went down a little bit, the total profit would be about 0.68%. And without the call writing, my profit would be actually negative. It would be a loss of about 0.15%. Another trade I made in March, I had 400 shares of Amazon, and Amazon was trading at about $95. And I was pretty conservative. I sold the call at the strike price of 101, which is quite far away from 95, right? It's about 6.5%. And so the call was expiring in 2 weeks. And in 2 weeks, Amazon was trading at about $99, which was still below the strike price of 101. So the option again expired worthless. So I got about $250 income when I sold the covered call, and then additional, 4.3% from the stock going up. And so the total profit was close to 5%. And you can see the profit from the calls is very small because I write the calls far away from the underlying, because I don't actually want the options to get exercised. And I don't buy and sell the shares. I just keep the shares no matter what. And so selling the covered calls is just generating the extra income, the additional yield on the shares that I would own even without selling the covered calls. A few other examples. So AVGO or Broadcom, on the 3rd of March, it was trading around 634, and I sold the option expiring 3 weeks from that date, and strike price of 670. So again, 670, that's about, let's see, 36. So about 6, maybe 5% away. So the strike price was about 5% away from the price of the underlying at the time I made the trade, right? So 3 weeks later, a Broadcom was trading just a little bit higher, so pretty much not unchanged, and so the option expired worthless, and I pocketed the entire premium, right? So the income was about 0.5%, and combined with the profit from buying and selling the stock, the profit would be about 0.83, right? So in 2 weeks, instead of just having 0.33% from the stock, I have almost 3 times more, or 2.5 times more from buying the stock and selling the covered call. And another example, kind of the same thing, ISRG, I picked the option expiring about a week from that day. So, and then ISRG haven't changed in that week. So, my strike price was 265, which is about 4% away from the underlying. So again, the premium was not that much, but it was a pretty safe trade, generating, the income was like 0.68 and total profit 0.86. So pretty nice. One thing I actually just want to make clear, that I don't buy and sell those shares, the underlying stock or ETF. I just keep them in my account and opportunistically sell the covered calls to generate extra income. Now let's look at examples that are not as much fun, right? So a couple of weeks later, the previous example, ISRG, the option expired on the 31st, expired worthless. So a week later, on the 5th of April, I decided to sell another call. And this time, I actually wanted to sell the shares. And so instead of just selling the shares on the open market, I decided, hey, why don't I sell a covered call? And if it gets exercised, I'll be happy. So I was a little bit closer, right? So underlying was 258, and the call strike price was at 270. It's about 12. Uh, that's about that's about 3, maybe 3.5% away. right? And the expiration was 3 weeks from the trade date. And so it, it's not that far away out of the money, right? So as I said, I was okay with the options being exercised and the shares of ISRG being called away. So, however, what happened on the 21st, you can see the stock was trading at 300. So, in those 3 weeks, it gained 16%. In fact, it gained, I don't know, 10, 12% in the last 2 days because ISRG announced earnings 2 days, I think either Tuesday or Wednesday, just before the expiration. And the earnings were good. So the shares actually ISRG were gradually going up, which I was happy with. And then 2 days before expiration, they just shot up. And my strike price was somewhere here. So had it not been for the earnings, I would have been fine. But because of the earnings and large move, all of a sudden, the option was deeply in the money. So I ended up, the caller exercised the option, and I ended up selling the 100 shares of ISRG. So the caller exercised the option, and I had to sell my 100 shares of ISRG at the strike price, meaning at 270, even though the stock was trading at around 300 at the expiration time. So I still made money, obviously. I made, I made some money from selling the covered calls, and I made also some money by selling uh, the underlying stock at 270, right? So I bought it, or I had it at 258, and I sold it at 270. So altogether, my profit was about 6%. However, if I just bought the shares and sold them, my profit would be 16%. So, and these are the risks, that you have to watch for, and you have to be comfortable, once in a while being assigned. But of course, I do everything I can. This was a mistake on my part that I didn't realize there is earnings announcement before the option expires. So another example, no earnings report or anything like that, but I bought, uh, I had 800 shares of Microsoft. So on the third, I sold 8 covered calls, and Microsoft was trading at 255, and I really wanted to keep the stock. So my strike price was actually 275, which is about uh 50. Let's see, that's about 4% away. All right. Am I saying right? Actually, no, it's about 8% away. Right. So the strike price is far, far from the underlying 8%, 3 weeks. That's not going to happen. But unfortunately, it did. Right. So on the 24th of March, the stock was trading at 278, which was above the strike price. And if I just let it be, the buyer would, of course, exercise the stock option, and the shares would be called away from me. But I wanted to keep the shares. So instead of, let the option expire, I just bought the option back on the open market. And you can see the price of Microsoft was about 278.70. So the fair value of the stock option would be 370, but there was a little bit of the 7 cents was, a little bit of the time value in it that I had to pay extra. But still, so I was able to close the trade and lose some money, but keep the shares, right? So my income actually was negative in this case, about $2,300. But the profit, I mean, the shares went up by 9%. So I still made profit of about 8%. And without a covered call, my profit would be 9%. I put a star here next to Microsoft because this is only part of the trade that I made. And in fact, in my next presentation, I will explain how I actually manage the trade and manage to not only make profit from the covered calls, but also keep the shares. So from the previous examples, you can see there's lots of benefits to writing covered calls, but there are also risks. And we need to decide, should we write covered calls or not? It's everyone's personal decision, but let me just summarize the advantages, disadvantages, and kind of give you some guidance on when it's good to write covered calls and when it's not so good. So in the strongly bullish markets, it's not a good idea to write covered calls because, as we could see from the examples, uh, it's better to just own the underlying stock or ETF or even buying the calls outright. That's definitely more potential for profit. In the slightly bullish markets, on the other hand, it's to our advantage to sell covered calls. In neutral markets where the stock is not going anywhere, of course, it's good to sell covered calls. And even in the slightly bearish markets, depending on how much premium you can collect and what's the downside risk, but in general, it's still profitable, more profitable to sell covered calls. Well, if it's strongly bearish markets, then in general, it's better to stay out of those markets completely or even buy puts. And as you could see from my example, it's always a good idea to avoid earnings announcements. Those are announcements that can move the stock significantly, and since we are selling covered calls, that can actually hurt us quite a bit. And there are other announcements that you don't know when they come, but you just have to accept the risk. So also, you should try to avoid major policy events like interest rate announcements or debt ceiling negotiations and decisions, right? But unfortunately, there's so many of them coming out, every week or every other week. So it's hard. It's often hard to avoid those. So one thing I want to make clear is it's really difficult to tell in advance what the stock market will do, right? This week might look like the market is crazy going up, but there is no guarantee that it will continue going up. So what may appear as strongly bullish market can change very quickly and become neutral, right? Or even slightly bearish. So, like there are a few websites who like show, hey, in the past year, you could have made this much money selling covered calls using our strategy. But that essentially is not a fair comparison because they have the hindsight of knowing what the market is going to do. They know if the market was slightly bullish or strongly bullish, and they can adjust the strategy based on that. Like if it's slightly bullish, for example, I would put the strike prices a little bit further away from the underlying, right? If it's neutral market, then you can keep the strike prices closer and generate more profit that way. So, but overall, since we cannot predict the future, we need to come up with some solid management strategies, how to manage the covered calls, even if we are about to get assigned, right? Or even if the shares are about to be called away, can we do something to prevent that, keep the shares, and perhaps even increase the profit? And that will be the topic of my presentation coming up very soon. And so please stay tuned for that. If you like my presentation, please click the like button, subscribe to my channel. As I said, there's another presentation coming up very soon, and there will be more for the Option School series. So that's all for today. Until next time, happy trading.